So, following on from my last video where we were talking about finding actual informational ideas of things to build off of in the market, this is going to be talking about how to validate those ideas. Now, this is where most of the focus is because most of the ideas that come in will not be good, or you'll find something that invalidates them. And the whole purpose of this process is to identify essentially the ones that we go with versus the ones that we don't. Now, obviously, none of this is financial advice. Um, but when we go through this, I just want to make this clear. This video is not going to be super sexy or super fun. The goal of this is to provide something that's actually valuable. And so it's going to be going through a long list of questions that I ask when I go through and find an idea, specifically with stocks this applies to, but the whole premise could technically apply to a lot. But yeah, and this will be a work in progress. I'll be adding to this over time, but this is the process I go through to see, look, is this valid? Is it not valid? Anyway, so verify the information you have. So just like a scientist, you need to assess the validity of your potential information. So you need to understand, why is this trend emerging? Is this trend just short-term hype or buzz? And by the way, it's fine if it is. This is all about understanding what your edge is. Are you trying to predict like one round of company earnings? Are you trying to predict two? Are you trying to predict something else? All comes down to like how you answer these will, as negative or positive, will depend on what your particular edge is. So this is why it's so important to understand what that is. If you want to learn how to find that, I've got YouTube videos on this channel for free that you can check out. I'll leave them in the description. Is this trend spearheaded by a small group of loud people online? So this is very common if you've got an idea from social media comments, for example, or you've got it from forums and stuff like this. Because just because loads of people are being loud on the internet doesn't mean those people, honestly, without sounding rude, like have any significance to the particular movement of the stock or whatever. Like, they are just loud people on the internet. Next thing is there a clear want from consumers? Again, this is tailored to stocks, as I said. Can this want be validated? In other words, is there any data like search traffic, anything like that? How long is it likely to last? How likely is it to happen? How likely is it to have an impact on earnings? Have you seen enough evidence that it's happening or going to happen, etc.? These are just some general types of questions that I'm looking to answer, but it's also important to note that as we move through this, you'll notice more and more questions showing up that where I'm deliberately trying to disprove my idea. So I prove why I think that it's big and important to me first, but then I go through an arguably longer process looking for anything that could make that edge not work. Why? Because humans are very, 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 very prone to confirmation bias. What's confirmation bias? It's where you have a belief in your head of, oh, this is cool. Oh, I like this. Oh, I've come up with this. And so you generally try to look only for evidence that backs up your original belief, rather than being objective and looking at things and being like, right, this all add up. But there's also this counter argument which makes it not true. You need to be having both. Otherwise, it's not a fair analysis. I mean, imagine a scientist who only did experiments that would back up his own beliefs. He'd be laughed out of the room. All of the technology we have today wouldn't exist because all the scientists would be stupid, you know? So just think about that when you're, if you choose to go through this process. Next thing, is the information enough to impact the size of a publicly traded company? So bigger companies need more to move the needle. Now, what does more mean? It needs more slash bigger stories to move the needle. Pretty self-explanatory. Like, if you've got a publicly traded company that owns 500 companies and you're predicting like a slight boost in earnings on one of those companies, chances are not going to be a big impact. So again, this is the first piece of information that we have, first question we have, which is asking for a reason why it may not be as big of information as we originally estimated it to be. Next thing, is this a want or a need business model? How will that influence the most important factors that drive stock prices? So again, this is kind of self-explanatory. We just want to understand, look, what type of business is this? Is this one that's heavily based off consumer demand and hype and all this sort of stuff? Or is it something that's maybe like utilities? Everyone needs it. It's kind of not very high growth, but it's very stable. Understanding that will help us frame our information more. And it's not like you answer each one of these and you're like, oh my God, yeah, this is a yes, or this is a no. It's more about just making sure you are systematically putting this information into your brain so that when it comes to making a decision, you can make that knowing everything that you need to know to make the most informed one. Next thing, is the company diversified enough that this information wouldn't have a big enough impact? So this is very similar and arguably the same as this first one here. I've just asked it again. I don't know why, because I think this is just kind of like rough notes when I wrote this out. Next thing, is this just seasonal? Are these sorts of events happening routinely, and therefore does that negate the impact on the stock price? So what does that mean? There are loads of times where companies have seasonal sales, and a lot of the times those seasonal sales will be forecasted. If it's seasonal, if anything is predictable and repeatable and repetitive, just assume that it's already been priced in, people are already expecting it. I'll give you an example. If we have a massive earthquake in a third world country, and all of the infrastructure in that country normally would be like, oh, cool, maybe the energy companies are going to go down, maybe the building companies to rebuild things are going to go up. Yeah, that could be a genuinely good idea. However, if earthquakes at that magnitude or kind of just around that magnitude happen regularly or seasonally in that location of the world, then it's probably going to be partly expected. And so the edge diminishes. It's not to say that it disappears, but it does diminish significantly. Versus if an earthquake in that same region comes out that's 5 times or 3 times bigger than anything they've had in the last 10, 20, 30 years, because it's more emotional, because it's more unexpected, it will drive more attention towards both the story and, as a proxy, the stocks that surround it. So again, that's another example of not something that's a yes or a no. It's about taking in the nuance. This is why human judgment with this stuff is so important. Institutional models are weak on this sort of stuff because they're relying purely on things that are quantitative, but things that rely on judgment they are naturally bad at, which means that if we align ourselves to get good at the human judgment part, then we're aligning ourselves with the weakness of institutions. And considering our whole point, the whole method of this is to be right when most others are wrong, that's going to be a really, really important foundation to build off of. Demand. Is the demand actually going to grow or continue to grow significantly? If so, why? What could cause that demand to shrink? How likely is that? Again, just another question that is reframing a way that this information couldn't be as significant as we originally thought it would be. So supply, would an increase in demand be met with higher supply? For example, a lot of designer brands have fixed supply anyway, so demand increases either isn't needed or only makes them charge more. If they wouldn't increase supply, are they likely to increase the price or maybe capitalize on the increased demand in a different way? I'm just trying to open my own mind when I go through this as to, okay, how could this work? How could that be? How could this maybe influence it? What does that mean? Like, could that be? I'm basically just prompting myself to ask questions that I wouldn't probably have thought of because I'm wrapped up with the excitement of, oh, I've got this new idea or whatever. By the way, a little kind of side tip as well. For me, I always separate the ideas process from the validation process. So I'll just let ideas come to me throughout the day as I see, the news or not, if I'm on social media or whatever, or even in the real world. And as those ideas come, I'll write them down in notes. And then at a later stage, I'll go through them. That way, it kind of breaks that emotional charge of like, oh, this idea is going to be amazing. Let me follow up on this idea, because it can lead to biases that way. Next one, would they be able to provide that supply to fill this demand? E.g., maybe a wine brand can only use certain grapes that only flower at certain times of year, etc. One of many examples. Do they have the distribution to fill the supply? Are their supply chains good enough, in other words? And by the way, a lot of this stuff, as I said, it's not sexy. You going through this, you're not going to feel like Batman. You're not going to be like, oh my God, I'm like a genius with like in like a little weird hat and, making these crazy predictions. A lot of this stuff is going to seem boring, but this stage in particular is so important to do. And often the best results come from the boring work. Like the ideas are fun, exciting, cool. The validation, not so fun. Counterbalancing information, again, more negatives. The categories here aren't perfect. These are just like rough notes for me. So, could something else in this company's infrastructure counterbalance or neutralize our information? So, for example, let's just say that a publicly traded company owns 3 companies, and one of the companies is the one that you're interested in. You have information on it that, let's say, you're expecting earnings to increase. That's great. But have you checked the performance of the other two companies? Because if those other two companies are going to have a really negative time, or you research them and you're like, oh God, I think that they're really doing quite badly, the sentiment is really negative around them, then that could be something that neutralizes your information. And so knowing that's going to be really important. And you won't really know that until you've had an idea, you figured out, okay, who benefits or suffers from this, specifically in this case, companies. And then you can ask that question, be like, okay, well, what's that company made up of? How are the rest of the company's doing in there? What does that make sense? Make sense. And the great thing is you can use AI for a lot of this. But one thing I would say is that right now, at least at the time of recording this, AI is not quite there. It's not quite there. It can't take into account all this stuff. I know it's tempting these days. Everyone's so lazy now because of ChatGPT and whatever else doing all the work for you. But this is one of those things where it's really worth going through the information yourself if you can. Doesn't mean that you can't ask these questions and ask it to generate the data, but I would recommend interpreting the data yourself first before anything else, and doing it in a simple question answer format. It's always quite daunting, I know, to look at things from like the typical investor lens and do this really thorough analysis that looks really nice and neat and good on a spreadsheet. But really, it's just about human judgment. A lot of it's just cause and effect, common sense, trying to prove or disprove something. These are skills that all of us have. And if you don't have them, you can build them. So just keep that in mind. So, what's a simple search phrase that I can put into Google to get predictions on the next quarter's growth or other significant parts of this publicly traded company? For example, maybe a conglomerate has other companies that have been suffering, so it balances out the good information. Kind of just to follow up from what I said before. Does consumer sentiment align with the information? So, looking for social signs, if it's most companies will be a pretty good gauge of this. I'm currently building out a tool that does a lot of this for us, but is a little bit more like specific and goes through a lot of different elements altogether, but more on that when the time comes. Are competitors Oh no, wait, can external factors like regulations or technological advancements affect the impact? This is important to know because regulations are coming out relatively frequently, technological advancements, breakthroughs, loads of things, and these aren't exhaustive. Loads of things can have knock-on effects, right? So staying up to date, this is again one of the benefits of if you did decide to specialize, because you kind of know the areas to look at. You have specific like news sources for each of those things, and you can kind of like get around it in a logical way. Next thing is, are competitors positioned to capitalize on or counteract the trend? Would this remove our informational edge? Similar thing, we're basically just saying, look, could competitors dampen our edge, like our information? Another counterbalancing piece of information. Anything else that you see that could mess with this information? So again, allowing for a little bit of human judgment. You'll probably come up with better ideas here depending on the nuance of the situation. Anyone with a brain can be like, okay, I kind of get this, but until you actually have a specific stock you're looking at, it will become more and more obvious to you where these other areas could be that you should look at. Next one, historical assessment. Has this company been affected by similar events? In what way? Can you quantify the effect on stock market prices? How long did this boost last? Could this mirror right now? Were there problems? Have they been addressed? A lot of questions there, but they are just logical questions that anyone would ask if they're trying to validate something. Next one, the markets tend to react stronger to negative news. What are the current big negatives, if any, or things that could trigger uncertainty aversion that could stand in the way of the stock moving in my hypothesized direction? And are they enough to weigh against my positive outlook? So again, just a different frame, looking at it in terms of basically what are the narratives going on? What's the uncertainty? What's the likelihood of seeing X, Y, Z? Again, just opening the mind up to the possibility of more negatives. It's the whole point of what we're doing. Just read that one. Risk assessment, regulatory and legal risks. What are the potential regulatory or legal risks associated with this information? That's pretty clear. Market overreaction potential. Could this information lead to an overreaction in the market? Consider whether the market might overreact positively or negatively to the news and how that might affect stock price. volatility. Understanding this helps engaging whether a potential sell-off, as seen with LYV, might occur despite strong fundamentals. So a lot of this is going to come from experience to a certain extent, but it's also the biggest thing is about understanding the big fear. At any one time, there's normally one, maybe two big fears in that particular company, or whether it's a macro perspective in the economy. So maybe on a macro perspective, it's like sticky inflation, meaning inflation is expected to remain higher for longer. On a micro level, it could be, oh, this company's margins are shrinking because of their revenue stream, one of their revenue streams dropping. Like it can be anything like that. And so when you understand what the big fear is, you got to think about what an overreaction is. An overreaction is something that's fundamentally triggered by emotion. And so the more emotive you have a piece of information or whatever, or new information coming out, that is going to have more of a potential to influence that overreaction and cause that overreaction in the market. So is this development likely to have a sustained long-term impact, or is it primarily a short-term gain? How should this impact the time horizon / play I'm looking to exploit? For example, earnings play is different to a regulatory play. You should already kind of know this at this point, but it's important to know your time horizon and what you're trying to predict, because predicting, for example, that a company is going to do well over a year is very different to predicting it's going to do well over the next 3 months before the next earnings release, and even more different from predicting the next like macro movement and when that's going to happen. So really understanding that is really going to be very critical in order to make a kind of informed decision here about what constitutes an overreaction, what are the fears, how are people reacting already. It's also another vote to say, look, if you can specialize in like a few different areas, you're probably going to know this a lot better. Luckily though, there are tools today, one of which I'm building, which is nowhere near done, that can do this, or can at least aid with this process and allow for more ideas, more validation to be done quicker. It's never going to replace a human, but it's a lot quicker than most might think. Next thing, is this development likely to have a sustained long-term impact, or is it primarily short-term? I've just read that. How has the company historically responded to similar issues, things like regulatory scrutiny, public backlash, similar to one that we had over here? A lot of these questions may sound similar, but they're kind of just like, if you think about a question, opening your mind, like when you ask anybody a question, their mind is going to start answering it in their head, whether they like it or not. And because it's going to start doing that, when you ask the question a slightly different way, it may, open circuits in your brain a slightly different way and allow you to answer it in a slightly different way you didn't think of. So even though it looks like some of these are repetitive, they're not. Like this is slightly different to the last one, because scrutiny, public backlash are very different to what we were talking about earlier, which off the top of my head was, well, let's just have a look. Has it been affected by similar events in the past? Like, yes, it's similar, it's kind of the same, but it's also kind of different. How is this information being portrayed by the media, and how might public perception influence the stock price? So typically, the bigger the company is, the more coverage it has, the more it can be narrative driven. So the more narratives will have an effect, because that's just the way that it normally goes with larger companies, especially ones where growth is more exponential in nature, something like Tesla, these sorts of companies. Like, it's going to be more narrative driven. So it's important to understand how it is being portrayed in the media, the type of audience that it's got, all these sorts of things, and what their beliefs are. Economic factors. So this requires an element of macroeconomic understanding. If you're interested in that, I can break that down in more detail for you in another video. Is there a macroeconomic trend that can amplify or dampen our information? You'll find that most of the time, if you're ultra micro individual company, it's not going to be a crazy influence, unless it's something that you kind of can't really predict anyway. Like if Trump brings out tariffs or whatever, that can sometimes cause issues. However, for the most part, it doesn't. So next thing, could interest rates, inflation, or unemployment rates significantly affect the demand or supply that you're evaluating? Kind of similar to the first question there. Political regulatory risks. Are there potential regulatory changes slash risks that could hinder or support this trend? Could geopolitical events or trade policies impact this company's ability to capitalize on our information? Next, market sentiment slash behavior, similar to what we've done before. How does the current market sentiment, risk on, risk off, align with our hypothesis? Could a shift in sentiment negate the impact of our information? Risk on, risk off, if you don't know, it's basically a simple way of describing like how the market is feeling towards a particular asset. So if it's risk on, you know, money tends to flow towards perceived safer assets, things like gold, stuff like that. Whereas when when risk is off, it will move to safer assets. When risk is on, it will move to riskier assets, because people feel safer. And so kind of knowing where you are in that cycle can be helpful. You know, for example, if things are really economically tight across the board, then, you know, companies that, you know, for example, discount stores and places like that are probably going to do better, like on average, than, you know, premium stores or whatever. That's a massive blanket statement as well, but just as a general idea. Utilize some of the alternative data below that applies. So they could be things like social media mentions, Trends app, Google Trends, these sorts of things. They're just showing interest, essentially. Interest, and you can even go one deeper and use them to show and differentiate between general interest and intent-based interest. For example, if someone searches, I don't know, best places to surf, you know, that shows there's an interest in surfing, versus if someone says best surfboards to buy, that's going to show a intent of buying a surfboard, and those are different versions of using search traffic, and both tell you different things. Web traffic. You can track website visits, especially for bigger websites, and online engagement metrics to gauge demand shifts. So you'll find typically if a website's getting a lot more traffic, unless it's like a news website, it typically tends to correlate to higher sales. And it's data that most institutions will not look at, to my knowledge. Maybe they do, but if they do, they're not. Most aren't. Supply chain slash logistics data. So following shipping volumes, supplier orders, raw material purchases. If this stuff sounds boring to you, don't worry. Okay. The goal is not excitement here. Like, parts of the process are exciting, but if you're expecting to be excited by every part of every process that involves making money, then you're going to be disappointed, and you're also not going to do very well. So suck it up. It's so much easier to do this now than it was even 5 years ago. Like, AI makes this a lot easier to do all of this stuff. As I said, it doesn't replace it, but it makes it easier. So just think about that. App downloads slash usage, can't talk today. For tech related companies, track app store rankings and daily active users. Similar thing would be with the video game example, you know, using a platform like Steam, looking at how many active people are on particular video games or whatever. Like, these things are all important pieces of information. Then retailer stock availability data, so you can monitor out of stock rates or inventory levels for a lot of consumer products. So that'd be something else to keep in mind. And if you think about it, this is all a form of distributional data, which is something I was talking about towards the end of my last video. I'll leave a link for that below as well. Anyway, so final questions before we get to step 3. Based on all of this, do you think that my hypothesis is more likely than not to cause a boost in stock prices, or do the risks and counter information likely outweigh it? If this question is anything other than yes, I believe, like clearly this has a high potential of having a big impact, it's probably not a big like opportunity. Next one, what quarter slash earnings announcements are most likely to be affected and why? This is basically honing in on the execution time and understanding the consensus. Because if you're trying to beat earnings, which is basically what this whole thing is about, if you're trying to beat earnings, it's very important to understand which earnings you're trying to beat. If you're a little bit more broad, you know, looking at kind of the narrative rather than trying to beat earnings, it's going to be a little bit more consensus based. This question isn't going to make as much sense, but you can make estimations. You might be like, oh, like everyone's saying interest rates are going to go down. I think they're going to stay up for the next year for reasons X, Y, and Z. That's an example of applying it to a macro, but it's slightly different. So again, just kind of plug and play with whatever the asset that you're interested in is. And by the way, I'd be interested what that is. Like, if you have a specific asset you're interested in, let me know, because I don't know what everyone else is drawn to. Next thing is, if this is an opportunity, then when is the best time to get into the market to get the maximal result in terms of time before earnings, or if it's not earnings, as I said, something else. Again, kind of similar to the last question, it's all about time and timing. Then everything else from that point will be execution. So this is a validation process. You can actually go into a lot more detail than this. This, I would say, is actually a very basic overview of the process that I go through, because normally when I go through it, more questions show up, and it kind of gets a lot more detailed much faster, which I'm happy to show you if you would like to see. And yeah, now we need to go to consensus, which is the topic of this next video, because if you don't understand consensus, you don't understand where it is, then it doesn't matter how validated your idea is. Just doesn't matter, because it's probably already priced in. If everybody already knows it and everybody already appreciates it, chances are there's no massive edge there. So that's what the topic of this video is going to be. Somewhere around here. I'm trying to see my face. Yeah, somewhere around here, the video. And yeah, see you there. Take care. All the best.